Should we hold municipal bonds for tax planning reasons? Hi, it's financial planner Sean Mullaney. Let's discuss. This comes up among affluent folks, particularly affluent retirees. Should I hold municipal bonds, which pay interest that is not subject to federal income tax, for tax planning reasons in the year 2025? And, it's an interesting inquiry. And I think there's a movie from the year 1980 that can help us think through this question. That movie is Airplane, a great comedy classic. In that movie, there's a character, Captain Rex Kramer, played by Robert Stack. And he's on the walkie-talkie, and he helps the old Vietnam-era war pilot land a commercial airliner on the walkie-talkie. And he talks him through the landing. And then the joke is he keeps on talking, even though everybody's departing the plane. It's very funny. And he sort of wax eloquent on sort of life and living philosophy. And at one point, Robert Stack's character says something to the effect of, municipal bonds, AA rated, greatest investment in America. Okay. And this movie came out in the year 1980. Well, was there some merit to what he was saying in the year 1980? The answer is yes. It's interesting, but think about the landscape in the year 1980 for a second, right? You had federal income tax rates that quickly got to 50% or 70% in terms of income tax rates. You had treasury yields that were double digits. And you could see pretty quickly that holding taxable bonds in a taxable account, we'll come back to that in a second, could be very inefficient. If that's paying 12% interest and you're paying 50 or more to Uncle Sam, you might be paying 6% of the bond's value in income tax on that interest payment. That's no good, right? And then the other thing to think about is the lay of the land when it came to retirement accounts in the year 1980. No Roth accounts, okay. What about traditional 401ks, traditional IRAs? Well, the traditional IRA was born in the year 1974 in the ERISA bill, first possible in the year 1975. So even if you had maxed out 6 years, say, of IRA contributions, you didn't have a lot of room for assets in that traditional IRA. It wouldn't have held much of anything in terms of your overall portfolio. And even the traditional 401k that was born in 1978, first possible in the year 1980. So back in the 80s, in the early 80s, you didn't have a lot of runway to hold bonds in traditional retirement accounts. So if you were going to hold bonds, they had to be, generally speaking, or at least for the most part, in a taxable account. And that meant holding a high yield bond with 50% tax rates or even 70% tax rates for some. That was very tax inefficient. So reasonable minds could say, hey, those municipal bonds, even if I don't like the investment profile as much, that might make some sense. Yes, the interest is going to be lower because they know they're tax exempt, but still that could have made a lot of sense in the year 1980. Well, let's fast forward to the investment climate of the year 2025. Well, things have changed, right? Tax rates are down, yields are way down, and those are two important factors. But you know what's also changed? The runway we have on 401ks and IRAs. Back in 1980, they were crumbs for most even affluent Americans. In the year 2025, many affluent Americans have more than 50% of their wealth in an IRA or a 401k in these traditional retirement accounts. And most affluent Americans, look, I'm not giving any investment advice in this video, but I think it's fair to say that most affluent Americans want to have less than 50% of their overall portfolio in bonds today. That's just sort of what I've run into, and the stock market's popular and yada, yada. I'm not here to say that's right, wrong, or other. I'm not giving you advice, but I think that's just sort of the reality of the situation is that most affluent Americans have 40 to 60% or more of their financial wealth in traditional retirement accounts, and most affluent Americans want to have less than 50% of their holdings in bonds. Well, guess what we've just arranged? We have a great marriage right there. If we have more than half our wealth in traditional retirement accounts and we want less than half our wealth to be in bonds, why don't we just put those bonds and their yields and their interest payments, even if those yields go up, just throw them in the 401k or the IRA, invest that account that way through a good asset location principle. Great. And now that interest income every year is hidden away from our tax return. And oh, by the way, doesn't even have to show up until age 75 if we're born the year 1960 or later, because that's when RMDs start for those of us born in 1960 and later. So in today's environment where we have a lot of room to put investments in 401ks and IRAs, tax-exempt municipal bonds don't make a lot of sense. I'm not talking about an investment perspective. I'm talking about a tax perspective. Why do we have to worry about the taxation of bonds, regardless of yields, by the way, when we can sock all those bonds in the traditional IRA, traditional 401k, and they're not taxed until we take the money out, right? So today's environment, very different from the world of airplane and 70% tax rates and hardly any traditional retirement accounts in the year 1980. I think the difference in those worlds informs the tax planning desirability of tax-exempt municipal bonds. But let me know what you think about asset location, about holding bonds in traditional retirement accounts, about the movie Airplane, a great movie. Thanks so much for watching. If you enjoyed this video, please mash that like button and subscribe to my channel. I will see you next time.